welcome to this explainer. Okay, today we are taking on an absolute monster of a document, Pakistan's federal budget for the fiscal year 2026-27, and we're going to distill it right down into a clear, highly actionable investor guide. If you want to know exactly where the market is heading and where the smart capital is moving, you are in exactly the right place. Okay, let's dive right into this roadmap. First, we'll look at the macro outlook, then regional economic comparisons. Third, identifying the actual growth sectors. Fourth, we'll navigate the major market risks. And finally, number 5, we'll build out that investor action guide. All right, part 1, macro outlook for budget 2026-27. Here is the very first major signal you need to pay attention to, 4.0%. That's the government's official GDP growth target for the year. This number is huge, you guys, because it signals a very deliberate transition. The government is basically trying to move away from a period of really severe economic stabilization, and they're finally trying to push the pedal toward actual sustainable growth. But right next to that growth target, well, we hit a bit of a reality check, an 8.2% average inflation target. So while 4% growth sounds pretty promising, an 8.2% inflation rate means purchasing power is still going to be under a lot of pressure. Now, it's definitely a noticeable reduction from the crazy highs we saw in previous years, but it keeps our expectations grounded in reality, right? The government is trying to grow, but the everyday cost of living is still a heavily weighted factor. To actually fund this growth, the Federal Board of Revenue, the FBR, has been handed an incredibly aggressive target of 15,264 billion rupees. Just to put that into perspective, that is a massive 17.6% increase in revenue collection compared to the last fiscal year. This shows us exactly how hard the government is pushing to mobilize domestic revenue. They're aiming for a fiscal deficit of 3.6% of GDP, and this massive tax collection push, that's the engine required to hit that mark. Now, what's really interesting, and frankly a bit staggering, is where all that collected revenue is actually going. Out of a total federal outlay of 18.77 trillion rupees, 8,054 billion is strictly consumed by debt servicing alone. Let that sink in. That means nearly half of the entire federal expenditure is just going toward paying off old debt, rather than being invested into new infrastructure, healthcare, or development. It honestly remains the single most critical challenge looming over Pakistan's entire fiscal landscape. Moving on to part 2, regional economic comparisons. The regional contrast here is absolutely fascinating. If you look over at India, they're targeting a robust 7.4 to 7.8% growth, with a primary focus on capital expenditure and infrastructure and manufacturing. Sri Lanka, on the flip side, is targeting around 3 to 4% growth, keeping its primary focus entirely on post-crisis debt restructuring. But look closely at Pakistan and Bangladesh. Pakistan's targets actually closely mirror Bangladesh's recovery efforts. Both countries are targeting a fiscal deficit right around the 3.6% mark, focusing on that shift from stabilization into growth. The catch? Pakistan is trying to pull this off while wrestling with a significantly higher inflation target of 8.2% compared to its peers, plus that much heavier debt servicing burden we just talked about. All right, part 3, identifying growth sectors. To see exactly where fiscal policy is trying to steer capital right now, let's contrast two major sectors. On the IT and export side, there is incredible policy certainty. The government has extended their final tax regime all the way out to FY30, and get this, the 1% advance income tax on exports has been entirely removed. It's a huge win. Now contrast that with banking, which faces a strictly neutral outlook. Banks were actually excluded from the super tax cuts that other businesses got, and with the policy rate dropping dramatically from 22% down to 11.5%, banks are facing some real compression in their net interest margins. But listen, if there is one single sector the government is actively using as its primary growth engine, it's absolutely real estate. The government isn't just nudging real estate, they are practically removing all the speed bumps. Withholding taxes on property purchases, halved down to 1.25%. On sales, dropped to 2.75%. Even more importantly, the federal excise duty on real estate has been completely abolished, and that tax on deemed income from immovable property totally repealed. They are heavily incentivizing property transactions, which they are betting will subsequently trigger a massive boom in allied sectors like cement, steel, and construction. Beyond real estate, there are a few other highly strategic sector incentives we definitely need to highlight. Pharmaceuticals are getting a major boost. They're seeing zero customs duties on raw materials for locally manufactured cancer drugs, which significantly lowers production costs. Agriculture is also being heavily supported with a massive 20 billion rupee subsidy for DAP fertilizer to help stabilize prices for farmers. And over in the automobile sector, the government is looking to the future by extending electric vehicle incentives for another full year to really push green mobility. This brings us to part 4, navigating major market risks. So the crucial point here is understanding the true drag on the economy, and honestly, nothing illustrates this better than circular debt. We're looking at a 5.2 trillion rupee shortfall cascading right through Pakistan's energy supply chain. Now, the government does claim they've saved 3.7 trillion through renegotiated independent power producer or IPP agreements. But even with those savings, this massive persistent energy sector debt continues to strain public finances and heavily hinder any broader infrastructure investment or economic stability. Then we have the ultimate anchor for the entire economy, the IMF. Make no mistake, Pakistan's economic stability remains strictly tied to its adherence to the Extended Fund Facility arrangement. The government has set a primary surplus target of 2.0%, and this is completely non-negotiable. Any deviation from this fiscal discipline could jeopardize future IMF tranches. And if that happens, it could completely derail investor confidence and unravel all the stabilization efforts we literally just talked about. Finally, we have to zoom out and look at the broader systemic vulnerabilities. Pakistan is facing some massive external debt obligations. We're talking roughly 7.6 trillion rupees due in 2026 alone. The economy also remains highly vulnerable to global oil and commodity price shocks. And of course, let's not forget the incredibly complex geopolitical balancing act Pakistan has to maintain between major powers like the US, China, Saudi Arabia, and Iran. Actually, these very real regional security considerations are directly reflected in the budget itself, with the defense allocation being increased to a staggering 3,000 billion rupees. And now, part 5, the Investor Action Guide. All right, looking at all this aggregate data, here are the resulting strong buys based on the new fiscal environment. First up, real estate and construction. The major tax incentives we discussed, like the abolished Fed, are explicitly designed to drive immediate demand. Second, IT and exports. The extension of their final tax regimes provides the critical policy certainty that investors absolutely crave, making it a highly favorable environment for profitability. And third, pharmaceuticals. The abolition of customs duties on specific raw materials provides a direct cost advantage for local manufacturing. And this brilliantly illustrates why these three sectors really represent the safest harbors for capital deployment right now. Next, we have the watch list and neutral sectors. These are areas that require a more cautious, wait-and-see approach over the medium term. Agriculture has some really positive subsidies, but it remains highly susceptible to climate change and commodity price volatility. Electric vehicles? Great incentives for sure, but actual growth is heavily tied to local consumer purchasing power, which is stretched pretty thin by inflation. And banking and telecom are squarely neutral. They certainly benefit from broader macro stability, but they are facing margin caps and a lack of direct tax relief compared to the other sectors. Finally, we must clearly define the red zones. These are our high-risk categories, where the fiscal and geopolitical realities just create way too much turbulence. You want to be incredibly wary of any sector entirely reliant on government subsidies without a clear reform path, mostly because those subsidies could be slashed at any minute to meet IMF targets. The exact same goes for import-dependent industries. They are highly vulnerable to exchange rate depreciation and margin squeezes. And lastly, any company heavily exposed to regional geopolitical instability carries an elevated, unpredictable risk that you probably want to avoid. Which leaves us with the ultimate question as we wrap up this explainer. The government has clearly laid out its strategy, right? Slashing taxes in real estate and locking in long-term benefits for IT to kind of force economic momentum. But do these robust, targeted sector incentives actually outweigh the massive national debt burden, the persistent inflation, and the looming geopolitical risks? It is literally the multi-trillion rupee question every single investor must answer before deploying their capital in Pakistan this year. Thanks so much for joining me, and keep analyzing those markets.